Welcome to the show.
Hey Sarah, how's it going?
I know it's a busy time for you, getting everybody's returns and such out the door. So thanks for taking the time and connecting today.
Yeah, for sure. Well, it's nothing compared. I've got an 8 week old at home, so uh, tax season's nothing compared to 8 week old.
Yes, absolutely. I always say this, there's a reason that sleep deprivation is a form of torture. There's a reason for that. So hopefully you're getting to a longer sleep stretch soon. So for our listeners, I have Chris O'Shell, and Chris is a partner with Seamless, and we partner with Seamless a lot of times for our clients. They do work in an adjacent space to us, and I have told Chris that I need some more tax brain and legal entity structuring brain. So we were going to chat today a little bit about that. But maybe Chris, first tell us, about your background and how you got to where you are, and a little bit about Seamless.
Yeah, sure. Really quickly, I'm a CPA. Most of my career has been in kind of consulting, various types of consulting. So I started out my career doing litigation consulting and business valuation, and got into doing fractional CFO work after that. And as luck would have it, fate would have it, started a CPA firm, accounting firm here in the last couple years. And so uh, I escaped tax for a long time, and now it got me finally. So it just got me a little bit later in my career, but it's been a lot of fun, um, because I come at everything from a consulting background, and so I've kind of taken to tax in the same way and use it as a consulting tool.
Well, and as we'll kind of get into it, when I was a baby accountant, I prepared tax returns. So definitely can bring the consulting piece to that. I think, sometimes we get hung up, or we find that our clients get hung up on the compliance of the tax return, and it is definitely an annual process, but there's so much strategy into how you can plan for this, how you can plan for different generations. And, yes, you still have to file a tax return annually for your business and for yourself, but there's a lot more around tax. And I would guess I would term that as tax strategy, tax consulting.
Yes.
Yeah. Well, tell us, one of the things that I see struggling for clients and potential clients is really understanding their legal entity structure and which entity pays tax. Kind of give us a basis of, what are some of these pass through entities and why do we have them and where is the tax paid?
Sure. I think we see this often. People get hung up on the difference between legal entity and tax status. And so what I mean by that, a lot of times I'll ask somebody, "Hey, how do you? What's your tax status? Do you have a pass through entity? How's it taxed?" And you'll get an answer like, "Well, I'm an LLC, or I'm a corporation," and that's these are confusions around this issue. So when you think legal entity, think like these are the forms of organization that provide me certain legal protections and dictate, how what I can do from maybe a legal standpoint. And then there's tax status, which dictates what I can kind of do from a tax standpoint. When we're talking to folks, the most common legal entity structure that we see is an LLC, for example. And so if you go Texas Secretary of State, or whatever your state is, go to your Secretary of State and you form an LLC. The minute you form that, it now has a tax status of not an LLC. There's no such thing as an LLC tax status. It's got a tax status of either a partnership or a single member LLC, which is a little bit different, and we can maybe talk about that in a minute. So it immediately has a tax status. That tax status can change, though. So an LLC can have different types of tax status based upon what elections you make. And so both partnerships and S corps, which that's a different tax status, those are what are called pass-through entities, which means unlike a C corp, which whenever I talk C corps, think public companies. So public companies, they make money and then they pay tax on that money. And before that money makes it out to the shareholders, they've already paid tax on it once. In a pass-through entity, there is no entity level tax. So any money that you make in a pass-through entity, it goes straight out of the entity, never gets taxed, hits your pocket before tax is incurred. And so that's what the term pass-through entity means. It means all the profits pass through, they don't get taxed until they hit your pocket.
And I agree. I think the LLC is a very confusing legal entity type, and it is the most common. And it is it's a legal status and not your tax status. And so a lot of times in these initial years, it's important to be strategic. Like, you don't ever have things figured out your first year that you're in business, but you do need to have some foresight into how do you want to be taxed, and how are you ultimately going to pay yourself. So walk us through a little bit, because I've seen some issues where you're a single member LLC, or maybe you're a partnership, but you also receive W-2 wages, and that's a no-no. How can people pay themselves from some of these different legal entities?
Yeah. So as an LLC, right, your default status is that of a partnership or a single member LLC. You need to know what your status is to determine how you can pay yourself. So, for example, in a partnership, if your tax status is that of a partnership, you can't pay yourself W-2 wages. Those aren't a thing. So you pay yourself through what are called guaranteed payments. They're different. Guaranteed payments get taxed the same as profits coming out of the partnership. And they really don't look like W-2 wages at all. If you are an LLC that has elected to be treated for tax purposes as an S corp, guaranteed payments don't exist anymore. And now, if you want to get money out of the S corp without taking a distribution, it's going to be through a W-2 wage. And so, if it would be helpful, I can kind of talk through why you might want to do partnership, why you might want to do S corp, what kind of drives that. So, like I said, your default setup is going to be taxed as a partnership when you set up your LLC. And so that is a really useful thing for lots of purposes. A partnership gives you maximum flexibility in terms of what you can do. For example, in a partnership, you could have multiple partners with all different sorts of structures to how they're compensated with regards to the profits of the entity or the equity of the entity. Kind of sky's the limit there for what you can do. It also allows you to take what a term we call like disproportionate distribution. So if you have kind of let's say you're a doc and you start a practice, and then you want to bring in another doctor and they want to be an owner, but you started it and you want to have some special structure for them to earn within the practice, you can do that really easily in a partnership. So that's great. The downside to a partnership is any profits that you receive from that entity are going to be hit with self-employment tax. So maybe I'll pause here and we can talk about the difference between self-employment tax and federal income tax, if that's helpful.
Yeah, well, so the self-employment tax, kind of comparing that to your W-2 as an earner, you have federal withholdings, and then you have FICA and Medicare. And what the self-employment tax is doing is it's calculating that piece that if you had been employed by someone else, what that would be. And so for math wizards, it's about 8.3% of what that could be. So yeah, walk us through kind of how that could be different.
Sure. So you've got, when you think about managing your taxes, there's two buckets. There's federal income tax, which is paid by everybody, like W-2 earner, everybody pays self-employment tax or federal income tax. That's when you think about the tax brackets That's
Yep.
federal income tax. The other piece is employment taxes, which we're all familiar with from looking at pay stubs, and that's Social Security and Medicare. And those are split up. So if you're an employee of an entity, you're only paying half of the total the total employment taxes that are being levied. The entity who employs you is going to pay the other half. So if you're an employee, you pay 7.5%
Yep.
of taxes, but your company that you work for is paying the other half. Like you were saying, Sarah, when you're on your own, you have a company like a partnership, and it's paying you. You get to pick up both sides. So because you are the employee and excuse me, I said partnership, S corp. You are the employee and you are the employer, so you pay both sides of the tax. So it's a big number. So it's 7.5 times 2. The benefit to being an S corp is that you can pay yourself a W-2 wage, and in so doing, you can set a reasonable comp number for yourself. So let's say I could go hire somebody to do my job for $150,000 a year. I can set that as a reasonable comp number. I can pay myself that W-2 wage. I pay employment taxes on those wages. And then everything else I make above that number is not subject to self-employment tax. So, and that kind of goes off into infinity. So it can be a really big number. So if you think about the Social Security tax is capped at 170 some odd thousand of earnings. If you set your reasonable comp at 170, which would be a pretty high number, every dollar over that, you're going to save about 3%. So if you make, I don't know, $370,000, you got 200 grand, you're going to save 6% on. So it's 12 grand a year, right? My math good?
I think so.
Okay.
Yeah. And I guess I'm all for saving taxes, but sometimes I feel like as tax strategists, we can overcomplicate these things. But for professional services, I feel like if they're already paying employees and they already have payroll set up, this is just like adding you. I see sometimes, if you're the only employee, there's a lot of compliance around setting payroll up the first time, right? You've got to do all that. That makes it a little bit more cumbersome for you because you're not used to running payroll. Is kind of where I see some people get stuck. But if you have employees and you already have a payroll department or payroll processor, all of that, this is an easy add so long as you're in the right legal entity status.
Yeah. The only other thing I would kind of caution people about, the IRS has taken greater interest in S corps here recently. And so I see a lot of people, they file the form with the IRS to take their LLC from a partnership to an S corp. And that might be the only step in the process that they do other than setting up their payroll and paying themselves a wage. There are things that you should do with your attorney to amend your corporate documents so that you look like an S corp. And then there's things you need to do, like take meeting minutes, annual meeting minutes and whatnot, to kind of validate that if the IRS ever comes and looks at you, that you in fact are operating like an S corp. The reason that's really important is that if the IRS comes and looks at you and you filed this S election, but you've kind of been operating just like a partnership the whole time, they have the ability to revoke an S election for you, and they'll go back to whenever you filed that, and they'll actually call you a C corp from that point in time. So, not to scare anybody, it's a couple things you need to do to button it down.
Yeah, absolutely. And what do you think when you're looking at professional services, physicians, private medical practices, what is the most common structure that you see?
We see a lot. We see a lot of LLCs, and we see a lot of professional associations.
LLC, yeah.
PLLC, this kind of stuff. And Sarah, you may know more about this than I do, but my understanding on these has always been really for tax purposes. They're just kind of like an LLC, but they're only offered to professionals, and there maybe are some different legal protections to them. Am I on the right
Yeah.
path there?
Yes. But from like a general purpose, they work just like an LLC.
Yeah. So we see a bunch of those too.
And then what are people choosing as their tax status under those structures?
Yeah, so it depends, right? But typically, what you would do, what I see a lot is folks using these entities up above maybe a partnership. So if you say you have a multi-physician practice, what you can do is, we said you want flexibility is good, and it's a benefit of a partnership. So you could take your actual practice and leave it taxed as a partnership. Like maybe it's an LLC taxed as a partnership. So you have lots of flexibility with your various owners. You don't have problems with holding real estate, which is another problem with S corps. And then up above that, the individual physicians can hold their interest through like a PLLC or some sort of professional organization. That organization can elect an S status. And so what would happen is the partnership pays the S corporation up here, and then the individual physician can get a W-2 wage out of their practice. And that kind of is a happy in between scenario.
No, I agree. I think that's what we see a lot as well. If a practice doesn't have multi partners or they're not planning on bringing a partner, a lot of times we just see the practice itself choose to be an S corp.
Yep.
So that's another option. The real estate is interesting because that is another no. S corps cannot. Maybe I don't know if should not for sure. Have real. I think you technically can own real estate in an S corp, but absolutely everyone I know says don't do it for a variety of reasons. So, what we see a lot of times with our practices, if they're a solo practitioner, then their clinic is an S corp, and either if they own real estate or they own their building, that's either in a partnership or single member LLC. Sometimes, depending on individual tax planning for specific states, it makes sense for them and their partner to have a partnership. So there's some planning opportunities there, but they're definitely in two different legal entities.
Yes.
So they've got some planning around that. And then some of our physicians do research as well, and we will consider putting that into a separate legal entity, more so for future planning of if you sold off the practice but you still wanted to do your research, you already have that natural separation.
Yeah, I think that makes a lot of sense. Yeah, that real estate thing really is a big deal. And I've known enough physicians to know that physicians love real estate. So just keep it in don't put it in your S corp. Bad tax move.
Yeah, it's an expensive tax move, I guess, that what I would say. I guess talk a little bit, you and I collaborate with clients because your team is specializing. You do a lot more than taxes, but you are one of our go-to tax partners. Why is it important that they bring both their CFO and their tax CPA to the table in these discussions? Because sometimes, you and I do a great job collaborating, but we've also seen a lot of times where the tax team goes off and implements a structure and the CFO says, oh, well, we were going to do this in the future. There's that lack of communication. And then we're sitting kind of in a complicated tax situation.
Yeah. Well, so there's a tendency for tax people to make the tax tail wag the dog. And we want to stay away from that. So, tax decisions can't be made in isolation because there's almost always a trade-off. And so we really need to know what the goals of the organization are to make good tax advice. Like we talked about, it actually might be a terrible thing to do an S election if the organization has plans to admit future owners or wants to have profits interests or whatever it may be. So that's super important. And I know another thing we see, another reason why you would want to involve a Sarah or a Chris is attorneys have a propensity to do the same thing that CPAs do, is like to them, they're an attorney, so they're a hammer, so every nail they want to hit it, and so that might be great from an asset protection standpoint, but maybe it creates tax problems, or maybe it creates practical, just managerial issues, having to administrate this whole thing, where somebody like Sarah could say, hey, my guys aren't going to be able to handle 12 entities. So
Right.
it's important to have a whole team.
Yeah. Absolutely. Yes. And we love attorneys, but we all need to be at the table, right? And kind of discuss the different points of view. And
Yeah.
I think sometimes uh, business owners, when we ask them, and physicians, like, what do you want to do in 10 years? And it's like, I'm just trying to make it through the next year, And so sometimes we have to tease out what that potential could look like. And we've got to think a little bit longer range planning than, we're used to, instead of on a year to year basis. So tax planning to me it's not a year to year situation. It's what are we looking like in 3 years, 5 years, 10 years? And even generational wealth planning. Like, what is the plan for your family after you pass, you retire? All of those types of things need to be kind of shaped into this plan.
Yeah, absolutely.
Well, what are some of the different ways on retirement plans? Like, do we have some structures that you can't have a 401k in this type of entity, or you see, definitely benefits in this type of plan with this type of structure? Walk us through some retirement opportunities that physicians could be putting money into.
Yeah, so you might be out kicking some of my knowledge on what types of entities you can and can't have certain things in. What I'll say though is, when you have if you were a solo physician, you didn't have any employees, you've got lots and lots of options for what you can do. As you start to add employees, your options become a little more limited. And what we see most often used is 401k plans. It sounds kind of boring because everybody knows what 401k plan is, but it is probably the best way for a practice that's got employees to get money to the owner with kind of minimal tax implications to it. And the nice thing about 401ks is, and I believe this is still in effect, you get a tax credit for your administrative fees on 401ks for the first 3 years. So
yeah, it's either $500 to $1,000. Yeah, it's a nice credit.
Yeah, it's like it's a real number. So we see a lot of 401ks.
Yep. A lot of 401ks, when you talked about if you're the only employee, some of the things that we've seen, if someone is a key opinion leader, maybe they do a lot of speaking or something kind of outside of the practice of medicine, or, seeing patients, that maybe they're a solo practitioner in a different legal entity, and we work on some retirement planning where in that legal entity where they're the only employee.
Yeah. So something that, and I've used this before, that folks can use, is a SEP IRA. So SEP, you'd think it would stand for self-employed, but it doesn't, and I can't remember what it stands for. But SEP IRA.
I always thought it was self-employed persons.
No, it's something else. It's
Okay.
something else.
We'll have to Google it and report back to everybody.
I'm pretty sure you can fact check me on that. But the nice thing about that is, if you're a high income earner, you're going to be completely phased out of doing IRAs. And the SEP IRA doesn't really care about that. And it functions like a traditional IRA, meaning you're putting pre-tax dollars in it. So functionally what that means is, if you made, say, $300,000 in a year, you could take about $60,000 and move that out of your taxable income and put in an investment account for retirement. And you may be able to do that even if you've got an ownership in a practice, depending upon what your ownership is in that practice. If you have a separate entity out here that makes money, you might be able to do that, and like a 401k over here.
No, I think it's definitely something to bring and make sure that you're looking at least annually, or, in that long-term planning with your tax CPA. What about estimated tax payments? It's like the bane of everyone's existence. why are they so painful? And like, what can we do to ease that burden for everyone?
I don't know. They seem to be like the most overlooked way to save money on taxes. So a lot of folks we talk to want to do crazy exotic stuff, and we go and look, and it's like, well, can we start with making estimated tax payments? Because we could save you a lot of money there. So you're paying penalties and interest by not doing it. It's not actually that difficult, but you need to have a CPA who's engaged with you and can kind of help you plan. It is a fair bit of work for somebody to go kind of help you with that throughout the year. The default for everybody though should be look at what you made last year, look at what your tax was. If you're a earner making over $150,000 a year, you need to pay 110% of last year's tax in before the end of the year, the end of the current year. And if you do that, you'll make sure for sure that you're not going to have any penalties and interest associated with your tax. Like that's a good default position if you don't want to have tax payments. Now, if you want to get that tightened in to where, hey, I'm paying in taxes that really closely matches what I'm earning throughout the year, then you're probably going to need to work with your CPA to do that on a quarterly basis.
Well, and for a lot of our clients, we deploy the profit first methodology and move money into a tax account and work with the tax CPA to make those estimated taxes. But putting this in kind of, I call it the vault, right? Like we're not touching this money because that's really what drives the problem with like nobody likes to pay taxes, and that's just the truth. But what drives the problem and the anxiety around that is not having the cash to hit that number that you now have gotten. So we deploy strategies throughout the year on a routine basis of putting money into a tax account, helping with the tax CPA, giving them the, year to date through June, year to date through August, like help us come up with these estimates because it's the surprise part of the taxes. It's no one likes to pay them, but it's the surprise that's like the painful, how am I going to pay this? I stay up all night worrying about it. That's the anxiety around. It's the surprise is the anxiety.
Yeah, for sure. Well, I'm glad to hear that you do that. It's kind of funny. I'm a CPA, and you would think I would have like my personal tax situation super dialed in. The reality of what I do, and it works really well for me. I get really close. Usually have a little bit left over. Is I just take 30% of anything that hits my bank account and I put it in a separate account that's for taxes.
Well, I do it a little differently. I start at the top and only do 15. So the math is probably pretty similar.
Yeah.
And to be fair, I've also paid penalties. I had a penalty once for $200 for underpayment, and I felt like that was as close as I could get to the penny. So I was kind of proud of having to I nailed it. I nailed the estimate within a very close dollar amount. So that felt good personally. What about estimated tax payments? Are we having to make these electronically going forward, or can we still send in vouchers?
Yeah, I think later. I think sometime this year, maybe it's already happened. It's like electronic only now.
Yeah.
So,
and you have to go through the ID me process. And for our listeners, please do not wait until midnight to do that on the day these payments are due. It is a little bit of a process. I think you have to send in a picture of your driver's license and some of those types of things. So beware that is changing. Let's talk about just high level, the big, beautiful bill. Are there any strategies or anything that you see coming down that you think would be applicable to our audience?
yeah, the things that we're kind of focused in on over here. So one of the things, it's not really a change. Nobody's going to feel the change. Is the QBI deductions permanent now? So that applies to physicians who are under, call it like 350-ish thousand of income. You can get the QBI deduction, which takes 20% of your income kind of off the table. You're not taxed on it. It's a big deal. That's now made permanent. So that was part of the Tax Cuts and Jobs Act. It was a temporary provision. It was going to roll off. I don't remember when. But now with the big beautiful bill. It's a permanent part of the tax code, or at least until
we have our next permanent change. But yes.
So we have our next permanent change. So you never know. The big one though is bonus depreciation for us. So bonus depreciation was another a piece of the Tax Cuts and Jobs Act, and it was in the process of phasing out. It was almost gone. It was initially 100% of what you bought equipment wise in a given year could just be expensed out in the year you bought it. And then it was in the process of stepping down to where you could only take, 80% and then 60% and then 40% in that first year. Big beautiful bill took it back up to 100%.
And you know what I really like that? I mean, I like the concept, but what I like about it is that we don't have to have these year-end discussions on if I should buy it in this year or that year. I felt like there was a lot of planning around the timing of these bills happening. And so kind of like you said, letting the tail wag the dog of, we want to be holistic in the planning. I'm not a big person that's like, spend everything you can that last week of the year, go buy all the things that you didn't need anyway. If you were planning an expense, I do support that. Okay, maybe there's some timing here and you're going to have to pay taxes on it eventually. If you like the timing game, that's okay. But sometimes I felt with these temporary, like non-permanent cuts, if you will, that people were trying to really, quote, time the market on the taxes and maybe spending money or buying things that they didn't really need just to take advantage of the depreciation.
Yeah. That's one of those strategies that I've never quite understood. Yeah, if you need it, buy it. If you don't need it, don't spend $1 to save 30 cents.
I think that's yes, don't spend $1 to save 30 cents is exactly where we are. So, well, Chris, is there any kind of parting advice you would give to our listeners?
Well, yeah, I've got one thing. You want to hear about a tax strategy that we were talking about in here today that I think I'm going to start employing. So I've got a couple kids and we're thinking about this. So are you familiar with employing kids and kind of the tax arbitrage situation there?
Both Webkins do QuickBooks bank matching and are employees of Web CFO. So yes, I personally am, but let's go over it with our listeners.
Okay. So without taking us way down in the weeds, essentially what you can do, if you've got a kid that can perform a job function, an actual job function, it's not a fake job. You need to be able to.
Your 8-week-old newborn does not qualify for this.
Yeah, they're not a social media personality. Like you can't call that a job. That doesn't count. They need to be able to do something. So whatever age that is where they can start doing something, you can employ your kid. And if they're your kid and they're under the age of 18, there's no self-employment taxes on them. What's nice is if you think about your tax return, if you ever have kind of looked at it, everybody gets a standard deduction of, I think it's like $15,000 for 25. So you could pay your kid $15,000 in a given year and they would owe no tax. So that's awesome for your kid, but it's also awesome for you because you get the tax deduction for it. And then this is what we were looking at today, which this is crazy. If you really want to turbocharge it, have your kid take that $15,000 and put as much as they can into a Roth IRA. You've skipped out on the tax there. That now grows tax-free forever and then comes out tax-free. And we ran a little bit of math this morning on if you started doing this with your kid at like say age 6 and went to age 18, the money that you'd be able to move over to them, if they just put it in brokerage account, put it in IRA, didn't touch it, by the time they're 75, it would be just shy of $10 million at a 7% growth rate. I mean, it's like crazy money.
It is crazy money. So to further expound on that, so we started this a few years ago and we had both of our kids, we have a boy and a girl, they both had to write papers on the difference between a Roth IRA and a regular IRA. I swear one kid used the early version of ChatGPT to come up with their paper, but the answer was correct. And then the other one actually did some studying, and I could tell that child wrote their paper. So yes, we're on the turbo path of putting that money into a Roth IRA. I actually don't even let my kids see the money. It goes into their checking account and then it turns right back around and goes to their brokerage. So they're both aware because they have so many hours that they have to work per month. They have duties that they have to do each week, and that's part of me being a CPA mom of like, we're going to have some structure around this. But yes, I do think it's a way to turbocharge their financial future, but it's a way with that standard deduction to really maximize and get closer to that 15,000 of tax-free from tax-free planning. Sure.
Yep. It's better than a trust fund too, because they can't touch it.
I haven't moved that far. That's another level of planning. I just haven't had the ability. I don't know how I could get them their W-2 wages at the personal level and then through a trust fund, but I'm open to explore that and see what we can do around that. So, Chris, thank you so much for being with us today. How can our listeners get in touch with you? We'll have kind of your contact information in our show notes so that they can reach out. But what's the best way for them to connect?
Yeah, they'll have my email. If you want, you can provide them my cell number. I give most clients my cell number. Whether that's a good idea or not, I don't know, but they have it. And then on our website at smlsadvisors.com.
Absolutely. We'll probably link all that up minus your cell phone, but if someone needs to reach Chris's cell phone, they can reach out to me and I will screen you to make sure you're not a stalker and then connect you with Chris.
Perfect.
So, yes. Well, Chris, thank you so much for being on the show. And that's another podcast for Profits in Practice. Thanks for joining me on Profits in Practice. If you found today's episode helpful, be sure to subscribe, leave a review, and share it with a fellow physician. Your financial wellness is just as important as your patient's health, and we're here to help you thrive. Connect with us via our website at webcfo.com. Thanks for joining us.